Hello world, hello Australia, Jamie here, the crypto koala. Now today guys, I've got Edward Iskra, he's the Director at Communications at Bitcoin Gold. Great to have you here today, Edward.
Great to be here. Thanks, Jamie.
I understand that you're calling from the US, near New York, which is pretty interesting. So mate, Edward, could you tell us a bit about yourself and what inspired you to get involved with Bitcoin Gold, mate?
Well, okay. So I grew up in New Jersey, which is just outside of New York, and I've spent half my professional career in New Jersey and half working in New York City. I have a background in IT. I did data center support and help desk support for places like Pfizer Pharmaceuticals. 7 years prior to my current stint, I did a job as director of IT for a small New York investment bank. So I was already very into the IT side of things. And while I was doing that, I got to see the first boom and bust cycle of Bitcoin. I didn't get involved yet, but I was very aware of it. And I was watching the development of Ripple and watched the price of Ripple and actually thought about getting involved. But I didn't at the time. Years later, I had finished my MBA at NYU, which I was doing part-time, and left the investment bank to try to do something interesting on my own. And I got sort of interested as a hobby project into crypto mining, which I started doing as a GPU miner. So here I was, GPU mining. I was able to get in at a lucky time and saw the big rush of Ethereum in 2017. But as 2017 went on, I was also looking at other opportunities to do GPU mining, and I heard about this new coin, Bitcoin Gold, BTG, which was going to be like Bitcoin, but a GPU mined alternative. So that sparked my interest, and I got in touch with the team and have been an avid BTG follower ever since.
Edward, what was the main purpose of BTG in a nutshell? Like, how come it went over from the Bitcoin Genesis block?
So the why at all segment has to do with GPU mining. The original project name for Bitcoin Gold was BTC GPU, and that's still the name of our project in GitHub, BTC GPU. The idea was to do a version of Bitcoin which is mined on GPUs and not mined on ASICs, and that was really the genesis of the project. The project concept came about in the summer of 2017, which you'll probably remember was also when Bitcoin Cash was birthed. And Bitcoin Cash was sort of an outcome of the long debate on scaling within the Bitcoin community. There were people who wanted big blocks, there were people who wanted SegWit. They were contentious fractions for a long time, and then in the middle of the summer, Bitcoin Cash came out pretty much as a surprise to everyone with certain modifications. And people outside of that argument would look at it and say, this is really miners arguing with developers. You know, there's this group of people with a lot of power because they do all the mining, and it's hard to get into that group because to be a Bitcoin miner, you had to get an ASIC. Application-specific integrated circuit. You had to get a piece of specialty hardware that was only made in a few places. In fact, it was mostly made in one place by one company. So you'd spend thousands of dollars overseas, hope some hardware would show up someday so you could start mining, and still most of your competition would be warehouses full of miners in China. So we wanted something that was more decentralized. We all wanted decentralization, but we didn't know how to achieve it within ASICs. And BTG came out and said, let's go back to mining on commodity hardware that everybody has and everybody can buy without having to go through a small controlling set of parties. So when you mine on a GPU instead, you'd buy a GPU at your corner store. If you're a gamer or just an enthusiast and you have a good graphics card in your computer, you could start mining without having to spend any money on equipment at all. There's zero upfront investment. You could just become a validator on the system. You can run a full node. You could participate in mining. You could actually make coin profits doing mining without having to get into this whole world of esoteric hardware which has no purpose outside of doing this crypto mining. So that's really the main thing, to allow people to mine on GPUs again, to allow anyone to mine again. Now, beyond that, we really stuck to the core principles of Bitcoin. We're not saying we are Bitcoin. We're not doing a Bitcoin Cash move and saying this is the real intent of Bitcoin. But we are saying that once upon a time, Bitcoin was mined on GPUs. And before that, Bitcoin was mined on CPUs. And that was more egalitarian, that was more decentralized because anyone could get involved in the mining process. And because the coins that were mined, those rewards for mining, would be distributed to people all over the world. So we're trying to return to that sort of decentralized model on the mining and return to this network effect that happens when there are coins being distributed everywhere. But we're not saying that we are Bitcoin. We're more of a complementary coin to Bitcoin. We're an alternative coin and make no claims otherwise, but we're doing our best to provide a solid, legitimate project, something that people can mine, but they could also build on, they can also use. You know, it's very much in line with the technology of Bitcoin. If you develop on Bitcoin Gold, you're going to use the same kinds of techniques that you would to develop on Bitcoin. So you can use it as a learning platform, a training platform, but you can also deliver complete services on it. You could transfer real value on it. It's just an alternative to one store of value, Bitcoin. We now look at it as having two, and this other set is mined on GPUs.
It's good to see, you know, you're not at competition when you see some of the other hard forks and where you run that parallel. It's just another alternative. It's not sort of like a hash war, or it's not contentious. It's sort of, it's good where you know, you can at harmony with, you know, with Bitcoin. So
if I can add on to that also, sure. You asked about why we did this as a fork of the entire Bitcoin blockchain.
Yes, please.
We needed to make sure that we were doing this in a fair manner. And if we just did, you know, some sort of new distribution and most of the coins went to a couple of parties because those are the only people who started mining, you know, that wouldn't be fair. But if we use the existing Bitcoin blockchain and fork off of that, then there's an automatic and fair distribution to everybody who's already been involved in Bitcoin. Everyone who was an avid crypto miner has the Bitcoin already. So as of our start date, the day we forked the Bitcoin blockchain, there were about 16.5 million Bitcoin in existence. So as of that day, there were also 16.5 million Bitcoin Gold in existence. So anyone who had a BTC before had a BTG as well after. And they were distributed to people all over the world. Holders, investors, miners, this whole decentralized ecosystem of people. Plus, going forwards, every coin that was mined was going to be able to go to someone else all over the world. So we increased the decentralization beyond what it started with. But it also ensures that we have a solid history for all those initial distributions. You know, if we chose some sort of consortiums that control the system and gave each of them some amount of funds or sold them some amount of funds, then you can make an argument that it's not decentralized, that is very centralized. But we didn't want to do that. So the fork of the full Bitcoin blockchain ensures that it's fair and that it's out of the team's hands. Bitcoin Gold and the Bitcoin Gold team had nothing to do with choosing who got the coins. We don't have to worry about and audit how an airdrop was performed. None of that happened. There was no airdrop. There was no distribution. It was simply a matter of copying the existing blockchain. And if you had Bitcoin, you now have Bitcoin Gold as well.
So the whole Bitcoin community benefited from, you know, Bitcoin Gold when it was released. So that's really good to hear. So a lot of people see Bitcoin Gold as a store of value, which is good in itself, comparing that to gold. So do you see Bitcoin and Bitcoin Gold, as the name is, not just a store of value, but, you know, the actual use cases adoption wise?
Sure. BTG is absolutely a store of value, as is Bitcoin. Now, obviously, Bitcoin has a higher value per unit, but they both have tremendous potential to grow as the usage increases, as overall adoption increases. So obviously, it is a store of value. It's also, BTG is a great way to transfer value. And that's partly because right now we have very, very low fees. Any dollar amount equivalent of transfer could be done on the BTG blockchain now for a fraction of a penny, a small fraction of a penny. And that's partly because we have lots of space in our blockchain. We aren't as heavily used as Bitcoin, so we have more space. And although we adopted the 1 megabyte cap on the block size that Bitcoin has, we also included all of the advancements that Bitcoin had in late 2017, including SegWit. So we have a 4 megabyte cap on the overall block weight, We have the ability to introduce the SegWit transactions, but also as Bitcoin rolls out things like Schnorr signatures, we'll be able to implement those as well, which means we compress and save a lot of space in the blocks, which means we can fit a lot. It's going to be a long time before BTG starts having the sort of congestion in a block that BTC does. So we can expect that our fees will stay very, very low for a long time, which makes us an economical solution for a lot of purposes, including sending smaller funds back and forth. You know, if you're doing international remittances in Bitcoin on $50,000 of value, then a fee of $1 or $2 is no big deal. But let's say you want to send 20 bucks back to your family in another country on a regular basis. You know, you don't want to pay a $1 or $2 fee every time on 20 bucks, but if you use BTG to do it, you're looking at under a penny.
Yeah, okay. You sort of started touching base on the scalability sort of side of things. So which direction are you kind of going? The increasing the block size? So where Bitcoin Cash is going, or sort of the second layer solution, the Lightning Network? How do you see in the long-term future the best way, or maybe not the best way, but the direction that you guys are going development-wise?
We're very committed to taking the more decentralized approach. And in this case, that means not scaling the size of the block endlessly. If you don't trust the Bitcoin developers who say that block size is not a good solution, you could look at people like Microsoft's engineers who also looked at it and said that, you know, you're going to have to go with second layer solutions to really scale to the massive levels that global adoption will use. And that's because you don't need to have every single block that's validated to contain every transaction in the entire world. None of these super big systems in the world, like the Visas and the payment processors, none of them have every transaction processed at the terminal where you swipe the card. Those are batched and centralized. Bitcoin, BTG, we're trying to do things in a decentralized manner. So we want to make sure that it can be validated anywhere, which means you have to have a manageable block size. Now, with Bitcoin Cash, the people there are content to increase and increase and increase the block size, which means smaller users, people with home computers, won't be able to run full nodes anymore. So that means the validators will eventually be people with large computers in data centers, which will effectively be corporations. Whether or not they're legally corporations, they're effectively corporations. And if you're okay with that model, if you're okay with trusting some group of entitled parties to do all the processing and validation, then that's fine. You can use that coin. In the Bitcoin model, that's not acceptable. And for the BTG model, it's even less acceptable. I mean, we're trying to make sure anyone can mine, so we're ensuring that ASICs can't mine our algorithm. Obviously, we're not going to say, okay, we can make sure anyone can mine, but we'll increase the block size so much that people can't validate blocks at home anymore, so they have to rely on some central party to do it. That just wouldn't be the right way to go. But there are lots of solutions which don't require that. Lightning Network is one of them. Because we support SegWit and have since the day we launched, we're compatible with Lightning Network. We've already done a proof of concept last year with an implementation, a port of LND, which we're continuing to develop. We haven't rolled out, a lot of Lightning Network apps for BTG yet because we're still working on some of the supporting infrastructure underneath it. For example, we've got a full port of BTCD, which has pretty much been completed, which I think we're probably going to call BTCG. But libraries like that allow you to do things like support light wallets that can allow mobiles to use Lightning Network, Neutrino wallet, etc. So without a full suite of tools that allows Lightning Network to be really usable by a lot of individuals, we don't really consider it rolled out. But we plan to be putting that out this summer, shortly after we deploy our latest full node. We've got our latest full node is an upgrade to include a couple of features that we didn't have before. It brings us compatible to Bitcoin's node version 17. And it includes a couple of things that were previously disabled, like compact blocks. Compact blocks is really important for Lightning Network to be able to be used and implemented widely. We've also got our engineers, our lead developer at H4X is especially interested in Plasma and similar scaling solutions that allow for sidechains. We're definitely going to be moving in the sidechain direction in the future. Sidechains that are full sidechains allow a lot of great features. Lightning Network is a more limited kind of side chain. It's just, state channels, but a network of those state channels provides tremendous second layer capabilities. But also, we can increase the size of our block. We're not dead set against a change in block size. It's just that when and if there's enough transactions filling up our blocks so that congestion is an issue, we can consider doing something like doubling the block size. There's no reason, in my opinion, to multiply to 8 times the block size and then bang that up to 64 times the block size if we're not producing so many transactions that there's any requirement for it whatsoever. All you're really introducing is the possibility of people spamming the block with enormous amounts of transactions and knocking some of the full nodes off, which is something we've seen in the big scaling tests that we've seen from some of the big block factions.
It's good to hear that you guys are flexible, you're not rigid, and where you're able to, you and your development team are able to change or to the best situation to scale. So I just want to go back to your adoption side of things, Edward. So do you find, like, in your developing countries, so with Africa and in South America, where we see that potentially that could be a big uptake of Bitcoin adoption, do you see them places that is potentially good for Bitcoin Gold adoption as well? Not just with the use side of BTG, but also the mining side of things, because I understand, in South America, you've got, places like Venezuela, the electricity is really cheap. So, it's easier to, and it's cheaper to do the mining there.
No, you're absolutely right. We are seeing a lot of interest and a lot of adoption across the globe. There are parts of the world that are more highly developed where we see a lot of interest in BTG, like South Korea. There are also parts of the world where they're very technologically developed and there's broad interest in mining, like Russia, where we see a lot of interest in BTG as an investment or as a mining target. But in a lot of the parts of the world that are having currency crises, like Venezuela, yes, there's a lot of interest in cryptocurrencies. We're expanding a lot in Africa. We just had another person sign on to be a BTG ambassador in Africa in a new region. We're also very popular across South America. One of our bigger exchanges in South America, Bitinca, is an exchange that supports multiple local fiat currencies and is an exchange in multiple countries in South America. It's definitely picking up steam. It's funny because I'm based in the US, but BTG is picking up steam globally more than it is in the US, which is okay. Quite honestly, I'm the only really active member of the team on the board anyway, that's in the US. Our other board members, the active members, are in China. We have one in Colombia. We have one in Bulgaria, one in Spain. So we're really globally decentralized as a board of the organization. And so it makes perfect sense that the coin activity is going to be very decentralized as well.
Oh, great stuff, Edward. Yeah, it's good to hear that the whole team is decentralized globally. I guess, is there a member based in Australia by any chance, or?
We don't currently have a member based in Australia, no. Are you looking to join the team?
No, it's okay, but maybe put it out there if anyone wants to be an ambassador, possibly for Bitcoin Gold, put it out there. So where you're based in the US, and you've got a lot of experience there with the current regulation framework with crypto. Do you think that with the current US regulations at the moment, they're pro-innovation?
Oh,
for the crypto industry? I'd just like your opinion on that.
No. Sadly, the U.S. regulatory environment is not pro-innovation. Frankly, I'll say it's not pro-innovation, generally speaking, because there are a lot of people here who are focused on ownership rights for intellectual property. And things like copyrights have been extended and extended here. Patent rights are very extensive, and there are too many companies that make their entire line of business to become patent houses that buy up and control a lot of patents and then basically extort other companies for infringing on their patents completely unintentionally, just because there's so many patents out on strange processes that nobody would ever think to look for. And that sort of anti-innovation environment has not been good for the tech space. It makes some tech companies really, hesitant to develop, and we see how many battles there are, even between the majors, like Google and Apple fighting with other entities who claim they own patents to parts of the processes that are in their software. But I'm digressing. The question here really is about the regulatory environment for cryptocurrencies. And no, it's no better for cryptocurrencies in the US than it is for other technology. There are lots of financial regulations which are about protecting the public, but which end up restricting the ability of the public to freely do what they want. There are lots of regulations that are about making sure that companies are being upfront and honest about what they're doing. The disclosure laws that would apply to a security. And I'm all in favor of having good regulation. The problem is a lot of it is extremely restrictive and is based on, pre-technology days. The primary test of whether something is security, something called the Howey test in the US. It's based on a farmer named Howie who was trying to raise money to expand his orange groves, and instead of admitting that he was raising money to expand his orange grove, he instead set it up as like a lease where people would rent land from him where he raises his oranges. So it was a security, but done trying to get around the laws. So sure, you could use an example like that to set the law, but we're so much beyond farmers and orange groves when we're talking about cryptocurrency. This is extremely different. And the big players, like the existing banks, investment banks, but traditional banks, fiat banks, reserves, they have been in control of the money side of things and the regulations around funds for so long that they feel comfortable with the regulators and the regulations that are in space. They have their licenses to function in all the 50 states. They don't want to see somebody else coming in. Well, now in cryptocurrency, you've got all these players coming in who don't comply with any of those laws because they simply allow anyone anywhere in the world to participate. How does that fit into the existing regulatory structure, which is based around a farmer from the mid last century? It just doesn't fit. And it's really crippling. I mean, some of the basic rules are crippling. For example, if I have a little bit of BTG that I bought last year for one price, and then I use some of it to buy a cup of coffee today, you would think that that's not a taxable transaction. But what the regulators would like me to do is calculate how much did I pay for that BTG last year, and how much was it worth today in terms of the coffee I purchased, and the difference is my profit. So I should pay capital gains tax when I buy a cup of coffee. That's absurd. We need to have regulations that allow people to do simple, basic transactions without trying to calculate capital gains. And of course, the other thing that really drives people crazy, we're constantly talking to different parties throughout the world who are interested in deploying new products like a credit card or a banking-like system that's a little more open. And a lot of them are working to get into the United States, but they always tell us, okay, so we're going to deploy first in South Korea, then in Europe, and eventually we'll get to the US. I'm like, why eventually the US? And we always get the same answer. Because we need to get licenses in all of these different states, and they all have different requirements, and we have to do it one way here and a different way there, and it's ridiculous. We are supposedly an advanced, developed country, but instead we're run like 50 little fiefdoms when it comes to getting permission to do something financially. That's not good for innovation.
I hear you, Edward. I'm pro-regulation, but to a point where it gets so... but they can't move up with times, they can't modernize. It's based on the old monetary system, and it's sort of repressing innovation, progress, adoption. And it's really sad where the US is getting left behind, and because they sort of wait in every single individual state, is it 52 states in the US, have I got that right?
We've got 50 states and a couple of territories, but people debate about what should become a state.
Around that sort of region. So, and I guess a couple of them states, and I'm thinking of Colorado and Wyoming, but them sort of one by one, they are going pro-crypto. So It makes me think, do we have to wait to every single state, or like the majority of states become pro-crypto in order for the federal government and Congress to say, okay, let's really start looking at bringing the regulations and bringing up them regulations up to speed.
So hopefully that will.
So, you know, recently the big news at the moment, and it's everywhere, is currently with Facebook, with the release of Libra coin. Don't want to go massively into it, but I guess I want to see how that impacts on you guys. So, you know, Bitcoin Gold, and just comparing, you know, the Libra project and the Libra stable coin to, you know, BTG. You know, do you think that's competition? Do you think that's going to be, you know, good for you guys, good for adoption long term? You know, what's your thoughts for that, Edward?
I do think it's good for adoption long term. I'm not sure how successful Libra is going to be, given the amount of regulatory pushback they're now getting. You know, the initial big story was, this is Libra coin, this is how it works, this is what it's going to be. It's a, you know, basket of fiat supporting a stable coin. But the next day I was reading about the European Commission want to look into it, the American regulators want to look into it, and there's a tremendous amount of resistance suddenly. So I'm not sure that they're going to be able to get it up and running in as many places as they like to. And even if they did get it up and running in some number of countries, there are lots of countries where they won't get it up and running. For example, in China, you won't find a lot of Chinese people running VPNs to get around the firewall so they can run Facebook at all, never mind this new coin. But of course, BTG, BTC, the blockchains run just fine. The full nodes run just fine no matter where you are. So, you know, I think what's going to happen is the general public is going to see how much regulators are willing to get in the way of this new kind of innovation in the financial space, in the currency space. And when we see that kind of resistance in the face of things that is really just a basket of fiat currencies, you can imagine how much resistance we might see to, you know, real decentralized cryptocurrencies. But I think it will open people's eyes to this. It'll open people's eyes to the fact that the old guard is trying to prevent new technology from being useful. And I think it'll also, you know, to the degree it does get adopted, make people more comfortable with the concept of crypto. I'm a little older. You don't look like a young spring chicken either. So we probably remember a time when credit cards were new. There was a time when people were very wary of using credit cards. And then when people started doing shopping online, you know, I remember lots of people saying online shopping can never take off because no one will be willing to risk their credit card numbers online. And obviously, history tells us a very different story. Now there are people who are afraid of cryptocurrencies. Well, when a big company like Facebook says, no, we want to do a cryptocurrency, that's obviously going to tell a lot of people, oh, wait, this is a routine thing now. This isn't something that's new and weird and only done by fringes. This is something that's getting mass adoption. So that will make them all more comfortable with the idea. You know, Facebook produced, well, the Libra project or Facebook, whoever you want to call it, they produced a beautiful website with a beautiful wallet. They make it look slick. They make it look easy. They make it look user-friendly. And that's something we in the crypto space have been harping on for a long time, that wallets, especially things like hardware wallets, paper wallets, they're not user-friendly for people who aren't really technologically oriented. Facebook's project is going to show people that you can make user-friendly wallets and will make people less afraid to try to come in and use the existing apps that are out there. So it'll help people come in. It'll help people understand the regulatory resistance to technological advancement that we're seeing in the financial space. And I think those are both good for crypto broadly.
Oh, for sure. I think this onboarding, where the power of Facebook, where they can advertise to billions of people, and I think in the US alone, you know, it's near enough half of the people, adults, get their news from Facebook. So it makes you think, if they start advertising that to the populace of the US and globally, that's going to onboard a lot of people into the crypto space. And I think that, you know, when you compare Bitcoin or Bitcoin Gold to Facebook as an alternative, the education side starts coming through and people start learning, hold on for a minute, I want self-sovereignty. I want to have something that I control and not have, okay, just sort of another owner, another ownership or another master. So I think there's so many more benefits with Bitcoin than there are to Facebook. I think that a lot of the groundwork that Facebook or Libra will do, and all the projects that get involved with Libra, all the groundwork and all the sort of tracking through the mud with the regulations It's going to lay the sort of the groundwork, or it's going to clear a path for Bitcoin and the other cryptos. So I think Libra is going to do a lot of heavy lifting. It's going to start really waking up these central banks and these banks and start, recognizing, hopefully the US government as well is going to start waking up and start, with what we talked about earlier on with regulations, to start taking note and bringing that up to speed. So moving
there's
on.
one thing I'd like to add to that. It's also worth noting that people with stable currencies, whether it be in Euro space or USD space or wherever, if you do buy a bunch of Libra, which is a stable coin, you're buying something that's backed with a basket of those other fiat currencies, which means for a lot of people, for the first time, you're going to be deeply exposed to the idea of the values fluctuating. People who travel a lot always see at the time they travel what the currency rate is for the given country, but they rarely keep touch with that country for years and years and years to see how the prices diverge. Once you're putting money into a basket like a Libra, you'll be more aware how the prices are diverging. You'll be more aware of the fact that these fiat currencies do go down over time. They do have inflation. And that makes people more aware that there's inflation on their own dollar as well, or their own euro, or whatever their fiat is. And once they become aware of the effect of inflation on their savings, they're more likely to want to diversify into different assets, especially if they see, oh, my $100 worth of Libra buys me $90 worth of stuff now, but if I had invested in a crypto asset that appreciates over time, like BTC, like BTG, like many others, well, I would have had this much. And it's no harder to transact. It's no harder to acquire. I just use maybe a different wallet than Facebook's, but otherwise it's really just as easy for me to do. That realization coming to more people is going to be nothing but good for the crypto space.
And I guess moving now into with the actual Bitcoin gold as well, it's something you're sort of touching base on, is that it has a built-in mechanism in there where it has sort of built-in inflation, but where it's controlled. And I guess that's going to be, if I've got this right, for the miners, where you guys are proof of work, it's a sort of where they're getting paid in BTG tokens. Is that right? Is that as a sort of an incentive to hold the whole BTG, just like with Bitcoin and Litecoin? It has like a halving mechanism put into it. It's got like a block reduction reward put into that.
Exactly. Because we forked Bitcoin's code, we are very close to Bitcoin's halving date, but we're on the exact same formula as far as the halving. So at the time we forked, one Bitcoin block produced 12.5 Bitcoin as reward. And on BTG, each block bind produces 12.5 BTG as reward. That's the new coin supply, so that's also the basis for our inflation rate. So we got an inflation rate of like 3.7, 3.8% annually right now, and it's slowly decreasing as the supply grows by 12.5 coins per 10 minutes. And sometime in, I believe, April of next year, we will reach the block height at which the reward will cut in half from 12.5 to 6.25. So that means that the rate of new tokens being produced will be cut in half, which implies that given a constant demand, that the price will be driven up, which is exactly the kind of thing you're looking at, economically speaking, for Bitcoin in the same month next year, probably a couple of weeks after BTG. And it's what we've been seeing and talking about so much in Litecoin, because Litecoin's halving is coming up very soon. There's an active market of people who use Litecoin on a regular basis. And knowing that the supply of new Litecoin is going to be getting cut in half, we know that constant demand with half the supply means an increase in price. That's why people have been buying Litecoin in advance of the halving. The market wants to price in the anticipated changes.
Sure. Just talking about the developing countries again, and I guess when I talk about the mining side, because I guess with Bitcoin Gold, it's a lot of it to do with the miners. So I guess not everyone can afford ASICs. They are quite expensive. So I'm guessing that these developing countries, just someone that, if I've got this right, and if you'd be able to just tell me how easy it is to sort of get into mining. For the everyday person in developing country, could they just buy a laptop with a graphics card and get into mining?
you can easily get into mining anywhere in the world, but you can't get in with a really low-end graphics cards because, quite honestly, the formula for our proof of work, the solution mechanism, is an algorithm called Equihash. And the way it maintains its ASIC resistance, the way it maintains the fact that ASICs can't mine it, is that it requires a lot of memory to store the work in progress. And you can't do that on an all-in-one ASIC chip. An ASIC is super fast at whatever it does, but it can't have a ton of memory and access it all the time, the way it's required in the Equihash algorithm. Now, last year, we actually changed the parameters in our Equihash algorithm because the news came out that Bitmain would be putting out a dedicated ASIC miner that could mine the version of Equihash we were running, which is based on the same proof of work that Zcash was using. Now, we immediately decided to change our algorithm, change the parameters so it requires more memory, more than is possible to put on an ASIC chip. And that ensured, after our hard fork, which happened, I think, July 3rd of last year, after that date, that ensured that no ASICs can mine on our network. But that also means that you have to have a graphics card with enough memory. So the latest and greatest, obviously, you can mine. My oldest miner is a Radeon RX 560 with 4 gigs of RAM. Now, that's not the cheapest graphics card out there, but it's relatively inexpensive. It's clearly not a really high-end card. So there are plenty of cards. As long as you've got a good couple of gigs of RAM on there, plenty of graphics cards, both on the ATI side and the NVIDIA side, that you can use to mine Bitcoin Gold. And those are available globally. Those are available as commodity items. Even if you're buying them used, they're available as commodity items. And that's another thing to consider. You know, people's lives change. People have different needs at different times. If someone decides, you know, I'm going to put 2 graphics cards in my computer and they're going to be a little higher end than I needed because I want to mine as well as use my computer, great. And then later their situation changes, they need some cash back. You can always sell those graphics cards because you can use them for something other than mining. People can use them as graphics cards. So there's value that stays in them. And that's also part of why graphics cards are more affordable as a mining item. If you're a company selling specialty miners, ASIC miners that are used to mine currency but can't be used for anything else, you know, how do you price them? You can't price them based on any use other than mining. And the mining use, well, you price them based on how much the person can earn doing the mining. So if price goes up in a coin, the price of the miners goes up, which means the people who manufacture the miner are going to raise their price and charge you more. So what you're effectively doing is sending money to the manufacturer, which you then have to recoup over 9, 12 months of mining just to pay for the hardware you bought, as opposed to paying a fair market price for that hardware. Well, in the GPU space, there is an open and free market in GPUs because they're primarily used for video rendering, for watching video, but also for scientific computing. There's lots of people doing neural network on video cards because they're good processors with lots of memory. Well, another thing you could do is mine cryptocurrencies, but at least you're not paying extortionate prices for some specialty hardware because somebody controlled the supply.
Just thinking back to the, you know, last year, we're in sort of deep into the bear market, and you had, like, you know, piles of the ASIC miners just going quiet. So there's just people, all these big sort of warehouses full of ASIC miners, big tower blocks, and they're not getting used. They become redundant basically until the market picks up. So it makes you think, like, and another thing as well with graphics cards is gaming. And I think, you know, a lot of people can just switch over and use them for that purpose as well, which is really popular. So it's good that, you know, graphics cards can still be used for various different things, where ASICs, just for that singular purpose, if you have a downturn in your miner, you sort of got assets, physical hardware assets that can be worthless.
Yeah. And I'll be honest, during the depths of crypto winter, there were a lot of people who had put money into graphics cards to build mining rigs, me included. And we got to a point where the price of electricity was too high relative to the amount that I would earn on those cards for me to run them profitably. Now, Fortunately, I was also able to use mine for heat. Crypto winter happened to coincide with actual winter, so I got a little bit of mileage out of that. But happily, with the recovery we've seen in the end of winter and this past spring, has really brought up prices, and now it's profitable to mine again pretty much anywhere. There's enough revenue coming in, there's enough value in the coins that you're mining, that even if you're in a relatively high cost electricity space, you can be earning revenue while doing your mining. So miners don't have to be just, I do it because I'm committed to this project and I'm storing my mined coins because I think it's going to go up in the future. And now you can also legitimize yourself by thinking, okay, the amount I'm bringing in per day is more than I'm spending on electricity, so this is a profitable enterprise. I'm going to run this thing when I'm not playing my game. That makes perfect sense.
And even here in Australia at the moment, it's starting to become appealing to start mining here, even though electricity prices are quite high. You know, even here now with the market going up, it's kind of starting to become profitable again. So I just want to say, like mid last year, yeah, you guys had a 51 attack. What have you learned from that, you know, from that experience? Have you made it harder for a double spend attack to occur on Bitcoin Gold now?
There's a lot that we've learned. The attack, we actually had a couple of attempts last year. That was mid-May. We had a couple of attempts to do double spends using BTG, and as far as we know, several of them were successful. But those weren't really attacks on BTG. They were using our blockchain to attack exchanges. And that's important to remember because it helps explain why these attacks are done. For these 51% attacks, they were all done using rented power from NiceHash. So when there's a hash power market, which allows people to rent as much power as they were willing to pay for on very short notice for short periods of time, then people have a way to potentially do this sort of thing. And what's interesting is at the time, you know, the rewards from mining per hour on BTG were something like $37.50, $4,000 US. And the attackers who were renting the power on NiceHash were paying much more than that. Depending on the time of their attack, they had to pay so much to get enough power. They were paying anywhere like $7,000, $8,000 per hour. Why do you overpay? You know, why pay $8,000 to do $4,000 worth of mining? Well, the answer is they're not after the BTG at all. They're not interested in mining. They're just interested in doing it to allow their single transaction to be a double spend. And that single transaction happens to be a deposit of $500,000 to an exchange. So they deposit $500,000 worth of BTG, wait until the exchange confirms that deposit, which can take 6, 10 blocks to go by. And as soon as those blocks have gone by, they trade into something else like Bitcoin and withdraw the Bitcoin. And then they release all those blocks that they mined, which they kept hidden. They kept them in secret. And when they release all those secret blocks, suddenly the deposit of $500,000 is no longer valid. So from their perspective on the BTG side, they deposited $500,000, they pulled out $500,000, but in between they pulled out $500,000 in Bitcoin. That's the profit. So it's not an attack on us, it's an attack on the exchanges. So what did we learn? How do we keep this from happening now? Well, for starters, when we changed our algorithm to have a different algorithm from Zcash, that also meant that there were fewer other coins using the same algorithm as we are. Zcash and BTG and a couple others were all using that Equihash, but Zcash was by far the biggest producer of rewards, so Zcash had by far the largest amount of hash power. We were a relatively small fraction of that hash power, which means it's possible to buy a share of the overall market that's bigger than BTG's hash power. Now, in the new algorithm version we're using, BTG is the dominant player. So you would not just have to buy a large share of the hash power market, you'd have to buy the entire hash power market and make it expand to have enough to overwhelm the existing network, which makes it implicitly harder to pull off this sort of mining attack. On top of that, it becomes much easier for us to monitor. And it's no surprise that we've been closely watching the NiceHash markets for over a year now. We don't talk too much about the details of how we do our monitoring because we don't want to tell potential attackers what we're watching for. But we do share with our exchanges the fact that we're monitoring, and when we do see risks and vulnerabilities, we keep them apprised of what's going on. And in the event that there is an ongoing attack, we will definitely raise the alarms. We have back channels with most of our exchanges. And if it happens, we'll broadcast it publicly as well. Last year, when the attacks did happen, we did broadcast publicly what was going on because we wanted to get to all the exchanges and to all the potentially affected parties as quickly as we could. One thing we learned was a lot of exchanges are hard to reach. You know, if they don't publish any numbers and they've never contacted us and they don't respond to their own customer support addresses, we can't get information to them. We can't push facts to them. You know, the fact that somebody's being attacked right now, you know, we would love to tell all the exchanges, but we learned that, you know, they're not really set up to communicate with everybody that way. I would love to see an initiative among exchanges to have sort of a communications forum where they can all share risk information with coin teams, with mining organizations, because sharing just among one or two trusted parties doesn't tell you about what's going on in other parts of the coin ecosystems. You need to talk with the miners, you need to talk with the validators, you need to talk with the stakers, you need to talk with the coin teams. I'd love to have some sort of broad channel where we could all talk about risks.
I guess as well is that when you broadcast to the community, because, you know, the miners that are mining BTG have vested interests. And,
Sure.
you know, once they know there's attacks going on, like, they don't want that coin to be compromised. So there's a good chance that they're going to join in and try to battle to try and retake that hash power.
You made a really good point earlier talking about the rewards going to the miners. They also suffer when these 51% attacks happen because, you know, when 10 or 20 blocks are rolled back because a secret miner, you know, rented this hash power to take over the blockchain, they lose the rewards that they already mined. And, you know, 10 or 20 blocks of rewards doesn't sound like a lot when compared to $500,000 worth of Bitcoin being stolen from an exchange. But to the miners, that's significant. And that's part of why the miners are going to play a strong role in an upcoming endeavor of ours. We've been working on a protocol called CCBN, cross-chain block notarization, which will notarize BTG blocks to other blockchains so that we have a reference that can be used algorithmically to prevent these sort of takeovers from happening, to prevent these sort of reorganizations. Now, you know, the concept of notarization is nothing new. There are teams that have experimented with notarization, and there are a couple of great projects out there that currently use notarization, but most of them rely on either a sort of master node or notary node method where there are elevated parties which have more power than others, and they're the reference, or they have some sort of master list of what the block notarizations mean, so you have to refer to a central authority to know what the list is. We wanted a completely decentralized solution, and we believe CCBN is delivering that. There's a white paper that'll be coming out in the coming weeks or maybe a month or two, but we believe we put together a system that's completely decentralized. It uses the participation of the actual miners in the process of producing the notarizations. Everybody can monitor the notarizations, and exchanges will be able to protect themselves from these sorts of attacks. I think we can make these sort of secret mining double spends a thing of the past.
Oh, great stuff. You sort of touched base on what you're looking at doing in the short term development wise. So what other things the team looking at doing, you know, Q3, Q4, 2019, and the long term? You know, what are your main big ticket items that you're looking at bringing out?
Sure. Well, the main things right now are to get the new full node out and running, because that will enable a whole bunch of other initiatives that have been waiting for it, including more LND related applications and sort of a full deployment of Lightning Network. Later this year, we're going to be working on sidechain projects. We have already said that we have an active interest. We'll be developing Plasma on BTG, but we also have a growing interest in RSK. So we've been talking with the folks at RSK. We're going to be seeing about potentially having an RSK BTG bridge. And in the year after that, we'll probably be focusing more on building relationships, more on building on adoption of these side chains, adoption of Lightning Network, increasing our footprint within the global exchanges. So that'll be a very big focus. We need to make sure that we're properly maintaining our infrastructure and our code base for other developers. And that will become a push, trying to get more developers into the BTG space. Right now, the project is still fairly centralized as far as code development goes. It's very much mostly in-house or people we're hiring. But we want to keep that expanding. We want to get more outside parties involved because once we get past the initial inevitably centralized stages of this project, we want it to become more and more decentralized on the code side of things as well, not just the mining and the markets, etc. So we'll be continuing to develop technologies, but mostly we want to spend our future working with other parties who want to develop interesting things on BTG.
So ultimately, Edward, what's the long-term goal of BTG?
The long-term goal is to continue to provide a usable and valuable cryptocurrency where anyone can mine wherever they are and to contribute to the broader crypto space. We plan to continue contributing even to Bitcoin. We're a fork of Bitcoin, so we share a tremendous amount of code base. So things developed in the BTG space can be applicable in the BTC space. Bugs discovered on the BTG side, maybe bug fixes on the BTC side, and that's already happened in the past. We hope it'll happen again. We know we benefit greatly from the fact that there's so much work and attention on the Bitcoin code where we share a base. So when there are fixes out there for Bitcoin, we can generally implement them very quickly. It helps make our blockchain safer for our users because of the fact that we are getting those fixes from Bitcoin.
Great stuff, Edward. Well, guys, I guess I could give a quick disclaimer like I do in all my videos. Not a financial advisor. Do your own due diligence. And not telling you to go and get involved with BTG. Check it out for yourself, guys. What I'll do, I'll put down the links down below if you want to check out Bitcoin Gold. I'll also put the links down below if you want to check out Edward on Twitter. It's been an absolute pleasure talking to you, Edward. It's been a great chat. You have a good day, mate.
Thank you, Jamie. You have a good day too.
Thank you, Edward. See you later, mate. Bye.
Take care.